For a much stronger and smoother performance, check out today's stock market. The S&P 500 climbing to a level not seen since September 12th of 2008. That was the day before Lehman Brothers declared bankruptcy. Will this rally continue into next year is the question. Joining us now with some of the answers there, Tim Hayes, Chief Investment Strategist at Ned Davis Research, which does customized research for institutional investors. Early this year, he warned that stocks could drop in the second quarter, and they did. We've been on a run, though, Tim, ever since then. And, you know, we've watched the stock market just to have a steady march up throughout this month. Of course, September and October were fantastic months as well. How can you remain still bullish going into 2011 when it seems that all sentiment is that way? And, of course, most investors like to be contrarians.
Well, I think there's right now we're entering 2011 with some pretty good not only market momentum but economic momentum. We had the quantitative easing, the QE2 announcement, and then following that we had the threat of tax increases taken off the table, and you know, we had a steady stream of positive economic numbers. GDP numbers are going to be coming out, most likely improved, and also it's a global in scope. We're seeing around the world that the outlook has improved, and this bodes well for the continuation of steady earnings growth going into next year. And we don't yet, while interest rates have backed up, we haven't yet gotten to the level where we have a broad-based interest rate threat that's going to put the brakes on this event. So there's a lot of positives right now for the market, starting out with the median stock in the S&P 500 has a PE of about 17. It wouldn't really look stretched until you got up around 22. So at this point in time, it looks like we do have the potential for this rally to continue well into 2011.
It seems like, though, Tim, you know, there's a lot of negatives as well. Obviously, you've got the situation in Europe. You've got the unemployment level here that not a lot of people expect to come down even below 9 until the end of next year. And then the fact that it would seem that all this stuff is priced in. I mean, everything you just listed there, we know already. So isn't that a concern that it's all priced in and we could plateau here?
Well, that is always the question. At what point will the market price it in? But our work says that while we do have quite a bit of optimism already, in fact, we do spend quite a bit of time looking at sentiment, and we've gotten pretty high in terms of optimism. But often what happens, you get optimistic, and you can get even more optimistic. And what I think we really need to be concerned about is if we do have this rally continue into the middle of next year or toward the middle of next year, with interest rates continuing to go up and with the valuations continuing to stretch out, then you're going to reach that speculation phase where the market really will be at risk of something bigger on the downside. I wouldn't be surprised to see intermittent corrections along the way like the one we just had, but I think our bigger concern will be going into the middle of next year, and we'll see if we have a bigger threat of even a cyclical bear market, something that we haven't had for a couple of years now.
And Tim, you're predicting a bear market from mid-2011 into 2012. That's a very long time. Where are you coming from there?
Well, I'm just looking at historical averages, and I'm not saying for sure we're actually going to have a bear market. What I am saying, though, I think this current rally will most likely run into some stiff headwinds once we get past the middle of the year. The average bull market usually doesn't go more than 3 years, and we'll be into our third year as of March. The average bear market lasts about a year or more, and I'm not talking about something like we had in 2008, 2009, which was a 54% drop in the Dow, but just something in the order of, say, 20, 30%. The average cyclical bear has been a 27% drop within a secular bear market, which is that longer-term trend. You've been down 34%. So I think we just need to look at some historical averages and remember we're back into a more normal pattern of these bull and bear markets, and we don't want to dismiss the possibility of another more protracted decline, perhaps starting by the second half of this year.
Let me ask you, Tim, about possible surprises for next year. You put out a note, 11 good signs for Q1 of 2011. You say plans for another monetary infusion via Q2, followed by a tax compromise. Do you expect quantitative easing, or QE2, to continue or strengthen, or even be followed by QE3 or QE4, as we've heard from a lot of people, Nouriel Roubini being one of them?
Well, the Fed has indicated they'll keep doing this as long as until they see signs of an actual positive impact, which is again a positive for stocks. But you know, the longer term is when the employment does start to improve. Then you start entering the real threat of inflation. Meanwhile, we do have interest rates backing up as expectations of inflation move up, and that's what I think will be the bigger risk as we get into the middle of next year. I don't think there's any risk right now of any kind of a deflationary slowdown that's that the market's going to be too concerned about. It's really on the other side of the spectrum, which is too rapid growth and too high inflation expectations.
You know, Tim, what are your thoughts on QE2 and how this round of monetary easing is going? Ben Bernanke has been very cautious about stimulating spending, but, you know, was this a good decision or not, and how is it being executed?
Well, I think ultimately it's a near-term positive, and that's what the market's been telling us, is that right after QE2 was announced, that's really what sparked this whole rally. And meanwhile, we're continuing to kind of make that transition from worries about deflationary risk to the recognition that actually the economy is growing pretty well. And as I said, I think the bigger risk down the road is by the time they actually start stepping on the brakes again, the risk will be really on the interest rate side and the inflation side. So ultimately, yeah, I think you have to say that it's been a good move so far. But on top of that, we have the risk of ultimately the budget deficits becoming a bigger threat to the markets as we get toward the end of this year, as deficit expansion begins to enter the radar as a real problem for the market. Then this could get things moving on to the defensive.
All right, hey Tim, thanks so much for joining us today. Tim Hayes there from Ned Davis Research. We're going to take